Hello. Today we will talk about internal control over financial reporting. So to start, let's discuss what internal control is. Internal control is a fancy word, and in a simple term, internal control is the collection of policies of a company. Those companies, to make sure their company runs efficient, effective, they need to place a lot of rules, right, to make sure everything goes the way intended. We have rules over for a company over warehouse management, over human resources, how to recruit people, for example, and over how to design compensation for management. And we have sales policies, we have rules about corruption, and we have logistic rules as well. Right? So of course there's rules about accounting as well. So those rules they are put in place to make sure a company is achieving its goal. Right? What is the goal of a company? Put it in a simple term. In the long run, to maximize shareholder owners' benefits. How do we understand it? Right? If we can give some examples. Long run, maximizing is important because if a company, for example, if a company, let's look at the company's participants, right? Involved in the company, we have not only management, we have shareholders, and we have employees, we have lenders, we have suppliers, we have customers. From the long run perspective, if customers are not happy, in the long run, it's gonna hurt shareholders, owners, right? If management do not work hard, it's gonna hurt shareholder owners as well, right? If the company don't pay suppliers in time, it will hurt shareholders. And if the company defaults, meaning not paying back its lenders, it might hurt owners even more because lenders can file bankruptcy for the company. Right? So all these are essentially in the long run benefiting the importance to shareholders. So internal control itself is a very, very broad concept, and it includes all the policies almost that is placed in the company. But as auditors, do we care about so much? Not really. We talk about the fraud. When people commit fraud, they try to cover up. They try to hide it to make financial statements as if the fraud never took place. And what are auditors' responsibility? Auditors go there, check financial statements that is prepared by the company, and issue opinion about whether financial statements contain material misstatements. Auditors are naturally against fraud. They are particularly against fraud over financial reporting because to them, a company, whether it's making a lot of money or not enough money, those don't really matter, right? Auditors can always give correct opinion about financial statements, its consistency with GAAP, and if there's misstatements, material, how much it is. All right, so for auditors, we need to really understand financial internal control over financial reporting and why internal control is so important. Again, if we think about a fraud, right, it's involving asset misappropriation and the fraudulent financial reporting, and they will happen to certain accounts, but for each account they might be containing so many transactions, right? If you think about sales, right, think about Walmart. How many Walmart do we see in Houston? How many Walmart do we see we might have in Texas, in the United States, and globally? And how many transactions, again, a Walmart might have a single day, right? So if you think about this, we know it's impossible for a company to really check all the sales transactions, and they can only check a little for auditors, right? So given this, how can auditors issue opinion about whether there are material misstatements, which might be the reason of fraud in the financial statements, particularly in the sales accounts, right? Auditors cannot, or they are feeling extremely uncomfortable to do so. So how can auditors feel better about issuing opinion about something they don't check 100%? They want to understand whether their clients have very good internal control policy regarding over financial reporting system. Only if a company has very, very, very good internal control over financial reporting, it can make sure everybody does its work It can make sure when there might be fraud, might be errors, it can either be detected or prevented. So companies can be reasonably comfortable to issue opinion after the limited amount of work they can do. Your parent wants you to check the homework of your nephew, and let's say you have two nephews, nephew one and a nephew two. Nephew one is very neat, right? Studies every day like a clock, and very tedious. And every time, after he finishes his work, he always checks very carefully by himself. Nephew two is quite not messy, but likes fun. Only do homework when he thinks about it, and he might be playing cell phone games, Fortnite or whatever stuff, when he's doing the homework. And once it's done, he says, "Oh, it's done. It's fine." He just tosses away the book and do his own thing. So nephew one has very good system over himself, right? He has a system over his schoolwork. Nephew two don't have such. So if you were to check both nephews' homework, right, there's no way for you to check all of them because you have your own life, right? So which one would you check more? Whose homework would you be more careful? Would you spend more time on? Probably nephew two, because there might be more mistakes in nephew two's homework, right? So for internal control, it's important as well for auditors to audit it, because if clients have very good internal control system over financial reporting, auditors can feel more comfortable, and then later when they are doing work, they can do less work. We'll talk details about it. And if a client has very messy internal control over financial reporting, the auditors might do much more work, spend more time on the client, and it might not be a good idea for the client as well, because when auditors spend more time, they bill client more, right? So client ended up paying more money for auditing service as well. So how do clients design an internal control policy that is good for them? Right? If you think about this, just like doing anything, before really to start, we need to understand what we are dealing with, what business we might be in, and who we're going to be dealing with, and think about how to operationalize all the procedures in daily operation. And by understanding those procedures, people gain insights about what risks are there, right? Pertaining to fraud, misstatements, people will think about, okay, look at all the procedures. At what stage, at which time the fraud, misstatements may occur, right? We call this risk assessment. From internal control over financial reporting perspective, we call it the risk assessment regarding the risk, particular to the financial reporting perspective, right? After understanding the risks of the company, right, of the financial reporting perspective, then we have to think about the overall, how should we view accounting? Whether we should view internal control over financial reporting seriously or not. Of course, the answer is seriously, but how do we do it? A company should establish a operating environment which highlights the importance, which understands the importance of control environments, right? Take, for example, after Sarbanes-Oxley, the law requires all the management, the board of the companies, it will consist of direct board members with business background, with accounting background. And those companies need to have audit committee that consists of independent directors, board of directors, members. So those also highlights how this environments of the control, or we call control environments, should be done. After this, we have to understand the control activities, because for a company to have control, to have very good reporting, to have good financial reporting system, control policies, right? Detailed policies telling people what to do, right? Telling people how to segregate their job is important. Instructions. So those need to be clear and reasonably detailed. With only these, it is still not enough. For a company, for the internal control policies to catch issues, right, and to fix issues, we need to sure there's channel of communication. Right? What is channel of communication? How the info, it's about information flow. Right? It's about how information flows from top and also flows from bottom to top. From top to bottom is easy to understand because when uh, directors, when high level people of a company, when they have their goals, they need people to do things, they can effectively give the information to everybody, to the employees, and make sure they understand what their job is. Right? On the other hand, we also need information from bottom to top because many issues only take place at the operation level, and the high level people need to hear it and fix it. One word I believe everybody heard about it is called a whistleblower. What is whistleblower? What is whistleblowing? Basically, it is done by the lower level employees or mid level when they discover, when they unearth issues, right? They report. We always say this whistleblowing is report to the public or to the outsider, but it's not internally true because those people need to report internally to the higher level first. Right? Only if the higher level ignore them, cannot do anything, then they can report to the public or to the outsider regulatory bodies, right? So whistleblowing is kind of an example information from bottom to top because nowadays all the employees, when they have issues, they always have the option to report internally to audit committee, to anti-fraud department, for example, within the company, right? So this is about information as well. And the different regarding daily operation, when employees, when they are carrying out their duties, when they realize issues, imperfections, or things need to be improved, they can always report to the supervisor, and the supervisor gather and review all the suggestions and report it higher to the top. So when we talk about information, when we talk about internal control, the whole system information flow is very important because no matter how thoughtful those people to design the controls, internal controls, there's always going to be issues at operation level, and we need to make sure those issues are fixed in time as well. And we need information flowing from bottom to top as well. Right? And the final piece of a sound internal control is always monitoring. Right? No matter how fine the policies are, we have to always keep in mind policies are run by whom? By human beings, right? And from what we understand about ourselves, about the world, we know that lacking monitoring, people will not do their job effectively, or we do not rely on people's self-consciousness, right, to do their job well. There will be monitoring to make sure the internal control policies are carried out, respected, right? So for example, right, the rule might say cashiers can never write checks over 10,000. Right? So whenever there's a 10,000 check, it needs to be authorized maybe by the financial manager, maybe by a higher level controller, such persons, right? However, the rule is there if there's nobody checking that. If cashiers occasionally issue a check over 10,000 and nobody cares about it, meaning that nobody, or the manager tells, hey, 10,000, you can still do it. I'm not in the office. I don't want to come to send this particularly just for the check today, right? Just go ahead and do it. The rule, the policies are not carried out. And if there's no monitoring, sooner or later, issues will occur, right? Fraud will take place. So those factors are important. So today we're gonna talk more about different types of internal controls. For auditors, right? Today's auditor, we do a lot of work about compared to 20, 18 years ago, we care much more about internal control policies. We mentioned some reasons already. Many companies, they are pretty complicated, right? They have a lot of operations, and if you work for Big Four, most of Big Four's clients are really huge. So it's important. It's impossible for any Big Four to check all the financial statement items, check all the journal entries, all the transactions of a client. So Auditors always need to understand the internal control of their client. Almost always, almost always. I will give some exceptions later. Um, right? When auditors have a client, how do you do your work? Do you just dive in and start checking clients' financial statements, journal entries? Of course not, right? It's just like I ask you to blindfold your eyes and I tell you, hey, there's some targets on the wall that are facing you. Can you just throw the darts and check how many, maybe hopefully hitting a few? It's not efficient way to do, right? I might just go ahead and ask, right? Can you tell me the left side and the right side, which side has more targets, top or bottom? So which one, which part has more targets? If I get those information, even if I got my eyes blindfolded, I can still throw my darts and maybe possibly hit more. Just a heads up. When we talk about internal control policies, I want to spend more time talk about categorization of internal control policies. We need to understand what our purpose is, and we need to understand the client, what are the operation procedures. Then we have different systems of categorizing internal control policies, so we can understand, have more insights about those policies, right? So from a internal policies, how broad it is from this perspective. And generally, we can categorize internal control policy as entity level controls and transaction level controls. What is entity level control? For example, we mentioned a bank may require all the employees to do drug tests every quarter, right? Unannounced, quarterly unannounced drug test. This is an internal control policy. It's not over financial reporting, but it's an internal control policy. It's a rule. So this is an internal control policy affecting the whole company. It's an entity level internal control policy. Or we can say that a company requires their accounting department to have ethics training every month. This is also an entity level control policy as well, because it affects a lot of people, right? On the other hand, we have many policies only affect certain transactions, right? For example, many company requires when salespeople go to negotiate contracts, go to sales terms, they cannot go alone. At least there must be another one accompanying the salesperson. Why such policy is to prevent kickbacks, bribing, those issues, right? So this is a transaction level policy, but it's not about accounting, all right? On the other hand, we also have transaction level policies. For example, we mentioned a company might have the rule that cashiers can only issue checks, authorized checks under 5,000. For 5,000 to 50,000, it needs to be authorized by the accounting manager, and for over 50,000, it needs to be authorized by the controller, right? So this is a transaction level policy about issuing checks, right? Affects one or not many accounts. Can we see that? They have a very specific goal targeting certain transaction. So it's a transaction level policies. For a company's internal control policies to be effective, it must be a collection of entity level policies and transaction level policies, right? On the other hand, we can also take from the fraud perspective, right? Misstatements perspective. We said if we look at fraud does a lot of harm to companies, right? And we can prevent fraud and we can also detect fraud. Of course, we do both, but which one is kind of better? Maybe preventing fraud is better because it's before the damage is done, but it might be difficult as well. Does that mean that detecting fraud is not important? Of course, it's not. It is still very important because only if we have, because there's no perfect preventive system that can really kill all the frauds. Remember, internal control policies are carried out by human beings, and human beings can always collude and to avoid the internal control policies. So detecting fraud becomes really important as well. I would say that at least as equally important as preventing the fraud, right? So if we think about when a company have certain policies, it's about preventing and detecting, right? So, and sometimes, and so for example, like we mentioned, right? Cashiers, when they write checks, it needs to be authorized. What is this for? It's not really for detecting, it's mostly for preventing, right? When you have such a rule, when people know cashiers are not supposed to issue high dollar amount checks, it's preventing fraud from such issues. On the other hand, we have policies to detect fraud as well, right? What if people collude, right? We may have people, for example, by the end of every month, internal auditors might view all the checks issued by the cashier, right? They need to see whether everything is done correctly. If cashiers issue checks over 10,000, right, or forged manager's signature, so internal auditors can catch it. This is a policy as well. What is this for? It's for detecting the fraud. But keep in mind, usually everything is not so clear cut. Some policies, a lot of policies might serve those purposes, right? It's more like an argument is death penalty or not. And those who are for death penalty, I think this makes sense. They are thinking that death penalty might not just punish those who committed horrible fraud crimes, right? It also stops some people from committing fraud. When they know what they do will lead to such consequences, they might think twice about what they might do, right? So when we think about detecting fraud, when somebody wants to commit fraud, when they know the company has very good detecting mechanisms, right? They might think twice about committing. So it sort of serves the preventing intention as well. Can we see that? So do not view the policies very mechanically as if when we talk about preventative controls, they cannot be serving the detecting purpose. It is not, right? Many policies can serve those purposes. But for us to understand, we want to talk about the role more specifically, and we put into two categories. Okay. And let me also give you another example. So it was a long time ago. I was so our advisory department invited me, not invited, they just basically somebody called saying that if you have time, we might need you on the job. So we were doing the ERP system consulting, internal control consulting of a very, very large client. And let me tell you what I did, and we can analyze what are those intentions, right? So we know that with a modern ERP system, everything is almost systemized and integrated into the system, computerized, we can say this. And so if we think about accounting, it's very much an information system as well, right? We have people, accountants, cashiers, sales department. When their operation takes place, right, accounting department put those data into accounting system, which is part of ERP. And then based on the design, the system processes all the information and put them into the right place, put them into the right category for use. Okay. Then at a certain point of time, we have some people needs to see, for example, I need to see my raw material report, I need the sales report, I need my gross profit analysis, I need my financial statements, right? Or I need to see salaries of everybody. So somebody over there press a button and there's information output generated for that party, right? So it's so much like a computer system. We have the information inputs and we have CPUs, we have the softwares to process, organize information. Then when we are looking at the computer screens, we see the things we want to see, right? So when we are doing the, when I was at the clients, basically I went to the clients. There's a few things we always do, right? I remember I asked, we always go to ask the accounting people, they know us already, they know who we are. So we asked them, hey, Jack, I need to check the ERP system of yours. Can I have your uh, can I have your username and password? What the answer should be. If you were Jack, what you're going to tell me? Are you going to say yes? If you say yes, you're going to be in trouble because this is part of the task of input. What is input of system information? Input, we need to make sure, for example, only those who have access, who are authorized to input, they can input, right? That's one thing. And we want to make sure the input system has some authentication process to make sure, again, same thing, right? The authorized person. And again, and also we want to make sure input system has some kind of security, has high level security to make sure not many people can hack, or they can only hack with high price, right? And we also want to make sure the system has some kind of correctness of mistake detection mechanism to make sure when certain mistakes occur, the system can correct it, right? So we do those things, right? So when I ask Jack whether he will share with me his password and username, what's the problem if he says yes, right? If Jack, first, the policy, everybody should stick to their accounts. If Jack shares with me his accounts so easily, then I don't have too much trust in the data input, right? Because Jack might share to other people who are not authorized, right? In this way, how do I trust the accounting information? Because the data, the raw data inputs might be contaminated already. So the correct answer from Jack is, I cannot do this with you. You need to be authorized. You need to talk to my manager, my supervisor, and my supervisor or manager will tell you whom to go to get your authorization. All right, so that's one thing we need to understand. All right. So usually when such answers occur, we already have our account already. We're gonna have a very unique account that we can view data, we can check data, but we cannot really we can have a pseudo system to input data, but we cannot really change the data in the information client accounting system already, right? So when we have the data, we also check the requirement to set up password, right? Common things like a password needs to be changed every few weeks, might be, and they cannot be the same as the previous password used already. Password has to have special symbols, uppercase, lowercase, those things, right? Some companies might be very strict about this from the data input perspective. When I was working, I remember KPMG give us a file, right? So every time when we input password, we need to first put our own password. This is a personal password. Basically, you change every 2 months or every month. I don't remember the detail. And on top of that, right, our file every 2 minutes generates random numbers up 16 digits or 12 digits, right? So we need to put those 12 digits after our personal password as well to log into our system, right? To make sure the information will not be contaminated or very less likely to be contaminated. So, and also when we use a pseudo system, we also purposely put wrong information, right? To make sure the system has some ability to catch mistakes, right? What wrong information do we put? For example, there's a journal entry, debit cash 1 million, credit sales 1 million, right? They pinpoint to the same transaction, same log. So if we have cash 1 million on one side and 1 million and 1 cent on the other side, we would expect system to tell you that, hey, the credit side is wrong, or the credit side don't match debit side, please check. So this is what we call some sort of auto correctness, right? So input control, we need to have those controls on the input side, all right? So output, it's straightforward, right? What do we mean by output, right? Output means that the information output should be correct. That's the first thing, right? For example, the company had 10 transactions, 2 transactions, 1 million, 3 million sales, right? So we would expect the total sales to be 4 million, not 5, not 2.9, but 4 million, okay? So information should be generated. The numbers should be correct. And this should be what people want. If I want to see sales weekly reports, I don't want to see cost of goods sold. I don't want to see monthly, or I don't want to see daily, I want to see weekly, right? That's another thing. And the third is information needs to be available only to those who are authorized to, right? So for example, many people are interested in how many other people make, right? Who has access payroll, right? Payroll people to have access, right? So what happens? Should we allow other people to have access to such information? Of course not. We know problem occurs. Some people are not happy. Hey, I worked more hours. How does this guy get hired or made more than I did, right? As a company, the integrity, the working environment will all be screwed up. So another aspect of output is only available to certain people who are authorized to fields, right? So those things are important, right? So how do we test it? It's kind of relate to skip part, right? When we talk about this information system, we have information inflow, input, we have processing, right? We have processing and we have outputs. So we have accounting degree, but we don't have an IT degree or what. So for us, it's really not a practical to understand how process done, but we can always have a view to fields. So when I was at a KPMG, we also, when we go on the cloud, we were given a set of pseudo data, right? We know what data they are, and we know what results should be, but clients don't, okay? So when we ask the clients to build us a very specific accounts with specific authorizations, we input our pseudo data into the system, right? Because if the system, if the black box process everything correctly, the results we get should be the same as what we expect, right? So we do not need to know how the black box runs, but based on whether the results generated, whether it's consistent with what we want, we get an idea whether the black box operates well or not, right? And then on the other hand, we can also check the output to make sure output is generated correctly. Then we can also check the details policies about who has what kind of authorization, and we will, with the authorization from the management of the company, to check, accompanied by special accountants, to check whether they really, whether they have authorization to see information they are not supposed to see, right? So we secure kind of, we examine the input controls, process controls, and output controls, all those policies. Right? So this is a part of the work accountants do as well. All right. So this is all for internal control policies. The book talks more than what I mentioned, but I think they are all easy to understand. The work aspects is more fun, right? What do you do when you do? So if we think about jobs, they are not so, rocket science, right? Many advisory people, consultants, they are not doing things too differently from what ordinary people will do, right? So I will make the homework available by the end of today. All right. Thank you very much. Bye-bye.